Good morning to all participants of our webinar. We thank you all for being here in the first webinar of a series we will be hosting over the next months to discuss different incentives available in Puerto Rico. Today, we will be discussing opportunity zones and related incentives of the industry in Puerto Rico. Prior to jumping into our agenda, I want to introduce myself and my colleague who will be hosting you this morning. I am Caroline Lopez, Tax Manager in the Tax Consulting Practice of Kibane Grant Thornton here in San Juan, Puerto Rico. And with me, we have Clifford Colon, Tax Senior of our Tax Consulting Practice. If any of you are interested in signing up to our mailing list, please let us know in the chat box and we will gladly add you to our list. We will send the presentation at the end of the webinar, so don't feel the need to write everything down. Finally, if you have any questions, please use the chat box. We hope to get them during our allocated time. If not, we will contact you after the webinar with our comments to your questions. So let's jump right to it. First, I need to make a disclaimer. This presentation does not constitute tax or legal advice. If you do need advice, please contact your trusted tax professional. These are the values of a firm, and the values guide everything we do at Kibane Grant Thornton. This morning, we're practicing upon our responsibility to continue educating about this amazing industry of opportunity zones and the many opportunities available in Puerto Rico, both for qualified opportunity funds and qualified opportunity fund investors. So this is our agenda. The purpose, and again, we're going to be here for 45 minutes. So everything in our agenda will be from a macro and high level basis to help you understand at a high level the industry and the opportunities here in Puerto Rico. We're going to give you some background on the industry, talk a little bit about federal opportunity zones, local opportunity zones, certain tax compliance requirements, and then we're going to see a case study to help us sort everything out. In this opportunity zone industry, everything is used in terms, and these terms come from the law and the regulations at the federal level. So hopefully we don't talk in these terms, but we include this here just so you have a reference whenever we're talking about a certain term within the law and on our presentation. As a background, this is a federal program, federal incentive that was approved under the Tax Cuts and Jobs Act in December of 2017. This is a program that aims to attract private investment into economically distressed areas in the United States and its territories. An opportunity zone in general terms is a census tract that is a low-income community and that it has been designated as such under the designation process that was originally adopted under the U.S. Internal Revenue Code provisions. These designations were mainly done in 2018, and they are good for 10 years. So in this period of time, all the states had to go through a process of designation, and they could not name more than 25% of their low-income communities as opportunity zones. And the difference here is that Puerto Rico could name 100% of its low-income communities. That's why, as we are going to see, Puerto Rico is almost all of it is an opportunity zones. So these are the relevant sections of the law, Z 1400, Z1, and Z2. And we have 3 sets of federal regulations. 2 were proposed, and the final regulations came out on December of 2019, just before the pandemic. In Puerto Rico, we adopted a law in 2019 to adopt the program in terms of incentives for investors with capital gains in Puerto Rico, and to adopt certain incentives at the business level. We're gonna see those in more in detail further down the line. in Puerto Rico, the opportunities for fund investing here is not only in the real estate industry, as we will see, but in all areas of the industry that are open to qualification as a qualified opportunity zone business in the industry. So Puerto Rico has many incentives at the business level in different industries such as tourism, green energy. So do take into account that a qualified opportunity fund can invest in many industries in Puerto Rico. Today we'll be focusing on priority projects, which are mainly related to real estate, as we will see. So this is the map of the United States. The orange parts represent the opportunity zones that were designated within the states. As you see, they're pretty, spread out around the United States. And then the map in Puerto Rico, almost 98% of the island is an opportunity zone. So federal opportunity zones, and again, we are going to go at a very high level. These are very complex rules, long set of regulations, but this can provide some context as to the qualifications of a fund and how these funds are actually structured, and eventually how these funds can deploy capital into Puerto Rico. So keeping this in context, if we have a project in Puerto Rico looking to raise capital, this is a great opportunity to reach out to U.S. investors with certain eligible gains and make an investment through this legal framework of opportunity zones. So we're going to get through it in parts. We're going to talk first about the eligible gain. So basically, this is the incentive is designed to be granted to an investor. So this is a preferential tax treatment that is available for certain eligible gains, which are mainly capital gains. We have to have an eligible taxpayer, which includes individuals, corporations, partnerships. There has to be an investment of the gain within 180 days of the realization of the gain, and the investment has to be in a fund. Each of these items have a lot of requirements within the item. So again, it's very important to understand the general concept and then dig in deeper as to, hey, do I have an eligible gain? Who is my investor? Did the investor invest the gain within the period of time that had to be invested, etc. So in general terms, again, the gain is a capital gain or any gain that is treated as a capital gain for federal income tax purposes. It has to be recognizable on or before January 1st of 2027 and is not a gain from a sale or exchange with a related person. So what are the benefits? The first benefit to an investor who invests eligible gain in a qualified opportunity fund, first is the deferral of the gain. So let's say I have a capital gain this year in 2021, and I invested timely and within the federal regulations in a qualified opportunity fund. This year, 2021, I'm not going to pay tax on it. The tax is going to be deferred. It's not that I'm never going to pay tax on it. It's a deferment, first of all. And then certain step-up in basis apply depending on the timing of the investment. So if my investment is the investment of an investor is held for at least 5 years, I'm going to have a step-up in basis of 10% of my gain. Individuals that invested prior to 2019 had a step-up of 15% in their gains. And then there's a 100% exemption on the investment appreciation if the investment is held for at least 10 years. And this is the part where the benefits are actually the most attractive, because the appreciation on the investment, if the investment is sold after 10 years, then that new appreciation, that new gain, is tax-free at the federal level. So the deferment is until the earlier of December 31st, 2026, or the disposition of the Qualified Opportunity Fund participation investment. So what this means is that if I invest this year $100 in a fund, I'm not going to pay tax this year, and then on 2026, I'm going to pay $90 on that investment, and that payment will be due on that date on that income tax return for 2026, and the capital gain rate that will apply will be the one that is effective for that date, for that year. So very important for an investor, the investor has to make an election. This is not automatic. It's used using Form 8949 in the U.S. return. It has to be timely made with a timely filed U.S. return on the year of the investment, and the reporting is basically disclosed as we include in this slide. The code is a Z code based on the instructions of Form 8949, and in that last column you'll see the gain or loss is 0 because there's a deferment for that year. So a qualified opportunity fund can be either a fund that is that has only qualifying investments, investments that come from these eligible gains. It can be a fund that has certain investments that are non-qualifying from an individual or a taxpayer that invested capital that is not eligible for this preferential tax treatment. And then we can have funds that have mixed funds. So this is not an all or nothing structure. The fund can have different types of investments. So what is a fund? A fund is an investment vehicle that is organized in the United States as a corporation or partnership for the purpose of investing in an OZ in the United States or in Puerto Rico. The fund has to have 90%, at least 90% of its assets in OZ property. Those are defined terms, and that is what we call the 90% standard or 90% investment standard. This is a test that applies yearly. It occurs at least 2 times in the year. Generally, if we're talking about a year that runs from January to December, we're going to have a testing period on June and a testing period, testing on 12/31 for assets. In terms of Puerto Rico, because the law was originally approved to require that the fund be a domestic property, the domestic entity, the regulations clarified that a fund organized under Puerto Rico law that invests in property located in Puerto Rico, then that entity will be treated as a domestic entity for purposes of these incentives. So we can have either a U.S. fund that is investing in Puerto Rico and U.S. property, or we can have a Puerto Rico Qualified Opportunity Fund that is investing only in Puerto Rico property. The fund has to self-certify each year. It does that using Form 8996 with the IRS, and it has to do it from the first year it receives an eligible investment. It's very important that the fund elects its effective date of being a qualified opportunity fund on a date prior to receiving its initial investment, because if an individual invests in an entity that it's actually not a qualified opportunity fund, then the gain will not be eligible for these preferential tax treatment. So that initial election and the date of effectiveness of the fund is a very important aspect of the setup of the fund. So there are certain requirements and certain rules to the 90% standard investment standard. One of the main ones is that the fund is given a grace period of 6 months from the receipt of capital. So the fund can exclude the investments that it has received in the last 6 months. So basically, the fund is given a grace period to have enough time to deploy the capital into opportunity zones. The qualified opportunity funds have to invest in opportunity zone property, right? And all these are defined terms. So what is opportunity zone property? It can either be direct investment in property located in the zone. Let's say I'm going to buy a building, then I'm going to buy it. The fund acquires the building, develops it, and operates it. Or and this is the structure that we see the most. Or the fund invests in a subsidiary in exchange for equity. So the fund is then invested in a business, in a separate legal entity, and that legal entity is the qualified opportunity zone property. This is a requirement, an additional requirement. Of course, the purpose of this program is to bring economic development to distressed areas. So the law is looking to provoke, right, and to accelerate economic development. So there are requirements that apply at the business level, and again, this is all in a very general term. So these entities, to be considered a business for opportunity zone purposes, it has to be engaged in a trade or business and have at least 70% of its tangible property owned or leased in business property, which has its own requirements. It has to be property in the zone, original use, or substantially improved. The trade or business carried out has to satisfy the gross income requirement, which requires that at least 50% of its gross income is from active trade or business, use of intangible property requirements, and a limitation on non-qualified financial property. So what this means is that this business has to be an active business. It can't be a passive investment, a net lease. It has to be an active trade or business. And there are some industries that are excluded and that are considered sin businesses that do not fall into the definition of a business for opportunity zone purposes. So these in general terms is the federal part of it. And why is this relevant? One, because a project in Puerto Rico might be looking for funding from a U.S. investor. So you're always going to have at least a good understanding of the requirements at the U.S. investor level and at the qualified opportunity fund level. And two, and Clifford is going to go into this a little deeper, from a priority project perspective, the priority project has to have investment from a qualified opportunity fund that complies with all these rules that we have discussed in a general term. So hopefully this is useful for you. I'm going to pass it over to Clifford Colon, who will be talking about local opportunity zones.
Hello, everyone. Thank you, Caroline. So for the Puerto Rico opportunity zones, our tax code, our local tax code, adopted equivalent provisions to those introduced on the federal code by the Tax Cuts and Jobs Act. And the main difference between the federal rule and the Puerto Rico rule is that the deferral only applies to capital gains that were sold or exchanged after November 7, 2018. So for federal purposes, it's during beginning of 2018. For Puerto Rico purposes, it's only November 7, 2018 and forward. The deferral benefits are similar to those in the federal rules. You will get a 10% step up in basis if you hold the investment for 5 years. And as Carol mentioned, that step up basis is only available until December 31st, 2021. If the investment in the fund is made after such date, you will only get the benefit of the deferral. The 5% step up in basis is no longer available because it ended on December 31st, 2019. And the bigger picture, if you hold that investment for 10 years or more, you get a 100% exemption on the appreciation of the investment. In the case of Puerto Rico investors, the deferral is made by completing Schedule OZ and attaching it to their Puerto Rico income tax return. If such schedule is not attached to the return in which the gain, which is to be deferred, the deferral benefits won't apply. So it's important that when you filed your applicable tax return for the year you want to defer, you include such schedule. To be eligible for the Opportunity Zone benefits, which is the priority projects in Puerto Rico, you either must be a fund or a business with a bona fide office or establishment in Puerto Rico, and you're performing one of the eligible activities we will be discussing further down the line. It's also important that the activity must be carried out in an OZ, in an Opportunity Zone, not be eligible for other tax exemptions or under prior incentive laws or under the incentives code, be carried out by the fund or an entity in which the fund invests, which in this case will be the Qualified Opportunity Zone business, and be carried out under the priority project incentives. So let's say, for example, you can either have a fund invest in a tourism project or a green renewable energy project, and you will still get the deferral benefits, but you won't get the priority project benefits because those industries already have tax exemptions under prior incentive laws or the incentives code. What is a priority project? It's a trade or business or any other activity performed to produce income in which you will be contributing to the diversification, recuperation, or social and economic transformation of a community in an opportunity zone. This definition ties with the public policy of the law, which looks to convert Puerto Rico into an investment destination for either Puerto Rico Qualified Opportunity Funds or Federal Opportunity Funds, develop local and foreign capital investments, and establish a tax framework for legal and regulatory purposes. Commercial activities are the activities that are allowed or classified as priority projects. One of the most important requirements of the Priority Projects Program is that, as we mentioned, they perform one of the eligible activities which were announced in Resolution 2019-01 of the Puerto Rico OZ Committee. And because of the way the law was enacted, a fund must be involved within the business structure of the operation. It doesn't necessarily have to hold a specific equity percentage or ownership percentage, but it needs to be involved within the business structure. Finally, the fund, the Qualified Opportunity Fund and the Qualified Opportunity Zone business if they request the priority project incentives, must be taxed as corporations for Puerto Rico income tax purposes. What activities are classified as priority projects? Well, Resolution 2019-01 included 4 specific activities. They are all related to real estate, which include the development of residential real property for sale or rent that is a low-income housing project, as defined by the Federal Code or the Puerto Rico Department of Housing. In addition, they also include the development of residential or commercial real estate or industrial real estate for sale or rent, or substantial improvement of an existing commercial property. Those are the 4 current priority projects that qualify for the incentives. If the activity you're looking to incentivize is not under the list, there's an alternative method in which you can submit to the Opportunity Zones Committee a request to qualify that activity in order to get the benefits. The tax benefits of being part of the Priority Projects Program is you will get a fixed 8.5% income tax rate on the eligible income that generates the eligible activity. That, to give you a little background, Puerto Rico has a normal tax rate of 18.5% and an additional surtax of that ranges from 5% to 19%, depending on the income that is subject to the surtax. So the maximum rate a regular corporation might be subject to is 37.5%. So you will get a reduced fixed rate of 18.5%. You will also get an 18.5% on withholding taxes for royalty payments, 100% exemption from distributions to shareholders, partners, or members usually in the form of dividends. You will also get from municipal and property taxes, you will get a 25% exemption, which at the municipal level, you could negotiate with the municipality to increase that exemption to 75%. There's a 5% investment tax credit guaranteed, which can be increased to 25%, which we will be discussing a little further down the line. And the benefits will be available for you during a term of 15 years. Usually a decree of tax exemption is issued, which is a contract between the government and the entity that requests them. One of the benefits that may help you with getting funding for the project is that if qualifications are met, 100% exemption on the interest income someone generates on bonds, promissory notes, or other obligations that are made to you, and you use that money for the development, construction, or rehabilitation or improvement of the building or real estate in this case. Tax credits. The general rule, which is stated in the incentives code, is that you will get an investment tax credit for the eligible percentage of your eligible investment made after July 1, 2019. July 1, 2019 is the date the incentives code was enacted. Prior to the incentives code, as Caroline mentioned in our background section, there was a law, which was Act 21 of 2019, that adopted the Opportunity Zones tax benefits for Puerto Rico, creating the Priority Projects Program. But the Incentives Code repealed that law. So when the drafting of the regulations, local regulations, was performed, a special rule was included to provide a credit for those investments made under the Act 21. However, currently, the local regulations are suspended, so further analysis will need to be performed for eligibility of the credit. One of the important aspects on the tax credit is that the ultimate owner of the credit is the investor, the individual or the entity that invests in the Qualified Opportunity Fund. Therefore, although the Qualified Opportunity Zone business or the priority project is the one that requests the benefits, ultimately the investor in the fund is the one that gets the credit. So the credit will pass through the business to the fund to the investor, so the investor can use it for tax purposes. An eligible investment, which is an important part of this, is any cash contributed to the fund that operates a business, Opportunity Zone business directly in exchange for equity in the fund, or you invest cash in the fund in exchange for equity, and the fund invest that capital into the Qualified Opportunity Zone business in exchange for equity. Or you invest directly into the business in exchange for equity if the fund invests in the business and the investment by the fund is compliant with the federal codes. federal code rules. During 2020, the OZ Committee issued Resolution 2020-01 to, among other purposes, adopt the criteria to determine the amount of the credit that would apply to a specific priority project in order to increase it to 25%, and establish eligible zones for purposes of the incentives code, which are conforming to federal opportunity zones. The additional credit is granted in incremental rates depending on the criteria that the priority project complies with. For example, for investing in a fund that invests in a priority project, you will get, and if the incentives are requested, you will get a 5% tax credit guaranteed. If that priority project performs activities that are related to substantial improvement as defined under federal regulations, you will get an additional 5%. If the priority project performs job creations, which represent a 25% increase in its prior employment list, you will get a additional 5%. If the priority project engages in developing for sale or rent affordable housing suitable for living environment in municipalities that are considered low or moderate income, an additional 5% is granted. And if the priority project performs development for education, health, or housing, an additional 5% is granted. So the priority project can work with either only the 5%, maybe the substantial improvement, and you will get 10%. If you add the job creation, you will get 15%, but you don't have to comply with all the requirements to get the additional credit. Only the ones that, for purposes of the priority project, is suitable to your business needs and structure. For the purposes of tax compliance requirements, in the federal level, as mentioned by Carla, the fund needs to self-certify by filing Form 8996. The form is filed annually with the fund's federal tax return. At the U.S. investor level, the investor will need to defer the election of the gains with Form 8949. And it needs to include with his annual federal income tax return, Form 8997, which is the initial and annual statement of Qualified Opportunity Fund investments. In this form, usually the investor knows the IRS how many investments it has in a Qualified Opportunity Fund, how many capital gains were deferred, and how many of those capital gains were disposed during the year. So the IRS can keep track on what you deferred, when you defer it, and if you didn't keep it until the recognition date of 2026, when you should recognize it then. For Puerto Rico purposes, if the fund and the business have the incentives for priority projects, the fund will file a regular corporate income tax return, but the business will need to file an exempt business income tax return, which is a different return that provides the special tax rates. The business will also need to file an annual report with the Department of Economic Development and Commerce, which is the agency that administers the incentives. And the report will be due usually on the 11th month of the 15 days after the close of the taxable year. So if you have a business with a calendar year, tax year, the report will be due on November 15th of each year. If the fund on the business do not request the priority project incentives, then they will need to file either a regular corporation income tax return or a pass-through tax return, depending on how the entities are taxed. At the investor level, if an individual, it needs to file an individual income tax return and include with the return the Schedule OZ, Deferred Gains. If it's a corporation tax treatment or pass-through tax treatment, then the applicable form, which is disclosed there. Taxable gains that are not deferred. So let's say I have a capital gain of $100. I only choose to defer 50. Then 50 will be reported on Schedule OZ as is invested in a qualified opportunity fund, and the remaining 50 will be reported as taxable gains in the Schedule D. Other important matters to consider is that we are expecting further guidance to be published by the Puerto Rico Department of Treasury regarding tax treatment for the opportunity zones in Puerto Rico and their correlation with federal tax provisions. There are discrepancies, as we have seen in this webcast, that between the Puerto Rico rules and the federal rules. For example, the tax treatment requirement for Puerto Rico to be taxed as a corporation. The date for the deferral for Puerto Rico is beginning on November 7, 2018. And there are some exit strategy considerations and reinvestment rules that will also need to be considered. Another important aspect is that although we had a local regulation for opportunity zones that was enacted and entered into effect on October 2020, and currently the regulation is suspended until further notice. In the couple of minutes we have left, we will discuss briefly a case study for you to be able to understand everything that we have discussed with you. So for the facts, we have a rehabilitation fund, which is an LLC under Puerto Rico law, which as required by federal law, its sole purpose is to operate a fund to invest in Puerto Rico. We also have Santurce Development, which is an LLC organized under Puerto Rico law, who will operate the commercial activities under the Priority Projects Program. The fund will be receiving qualified investments from U.S. investors or Puerto Rico investors, and all investors are considered individuals for purposes of this case study. We will, for purposes of the case study, assume that the fund complies with all the requirements to be considered a fund under the federal code, the tax code, and the incentives code. And the business also complies with the requirements to be considered a qualified opportunity zone business and a priority project. Both entities are taxed as corporations for Puerto Rico income tax purposes. The fund is taxed as a partnership for federal tax purposes, but the business is taxed as a disregarded entity for federal tax purposes because its only owner will be the fund. All capital raised will be invested in the business, and every requirement established under local law or federal law is met, meaning it's an eligible gain, deferred within the 180 days period, and everything that goes with it. So let's assume the business, the priority project, has a net income of $100,000. Since it has the incentive, the tax rate will be a fixed 18.5%, which will result in a tax liability of $18,500. There will be no tax on dividends because one of the benefits is 100% exemption from tax on distributions to shareholders owners or members. And once, assuming those $81,000 are distributed to the fund will not have any income tax implications because the pro rata share they are receiving in the form of dividends will maintain its nature of exempt and will only be reported but not taxable. The taxation from the fund to any U.S. investor, we will assume the U.S. investor's ownership in the fund is 10%. Then his distributive share will be $10,000 because for U.S. purposes, the fund was taxed as a partnership. It will get a 37% U.S. tax rate, which is the maximum tax rate for individuals. And the individual will get a foreign tax credit for the amounts paid in Puerto Rico at the fund or business level. And there will not be any tax on dividends. For simplification purposes, we did not include a calculation of the qualified business income deduction tax rules. They may or may not apply depending on the income thresholds established in the federal code. So keep that in mind when evaluating the example. For the taxation of distributions from the fund to Puerto Rico investors, because they will maintain their nature of exempt, the investor will report a dividend exempt dividend income of $8,150, but there will be no tax on it, so the effective tax rate will be 0. I would like to go back a little bit. For the U.S. investor, the effective tax rate will be 37%, and for the business, when it reports the eligible income and pays the taxes, will be 18.5%. This is the end of our presentation. We will be now answering any questions. If you have one, we know this may be a lot of information to have in almost 45 minutes, but it's just to give you a preview, a high-level overview of how priority projects are work in Puerto Rico, and keep tuning for our next webcast series on the next month.
Thank you, Clifford. Thank you all, and good morning. Thank you for attending.